late, but okay, perfect. So today is going to be all about kind of hard money and banking terms when you're doing a fix and flip or a new build for speculation purposes. If you hear a builder, developer, investor say they're doing something on spec, that just means speculation, meaning they're not doing it for an end user. Speculation is I'm flipping a home to sell it to somebody who already doesn't have it under agreement. So I'm doing speculation picks on finishes and styles, thinking this is what's going to be best in the market. So just so we're aware there. So I guess kind of 101 right off the bat, if I'm going to buy, we'll do an example. If I'm going to buy a fix and flip, I'm going to buy it, renovate it, and sell it. I want to maximize my debt because I don't have the cash to do everything, just with cash. So I'm going to get a hard money loan or a bank loan to do the project. The difference between hard money and conventional bank debt, hard money is typically going to be higher interest rate, higher closing costs, less underwriting, meaning they're not going to ask for W-2s, tax returns, cash in the bank. They're more based around the asset itself. And then typically you can close quick because you can close in, 2 weeks if you want, versus a conventional bank. You have to go through committees and underwriting, which it may take 30 to 45 days. So hard money is a very unique asset that we have, kind of at our disposal to make sure that our clients are getting taken care of as they need to be. We have tons of relationships with hard money people. So as you're talking to flippers, builders, investors, you have a segue where you can say, hey, I'm a hard money broker, meaning that you set them up with the debt to give them success. I'm a hard money broker, so let me try to save you some money on, the debt that you currently have, or we give you higher leverage. So going into some of the terms that we need to get familiar with, we'll just kind of start diving in now. Can you guys all see this, the notes popping up?
Mm-hmm.
Okay.
Yeah.
So the biggest one right off the bat that we're going to see is LTV, or loan to value. Basically, your loan to value is going to be the maximum amount of the loan that a bank is going to give you based on the asset itself. And what they use as a measuring tool is 70% of the end value. Or what you also might see is ARV, after repair value, what the property is worth after repairs are done. 70%, the bank is going to give you up to 70% because they don't want to be over leveraged. They want to make sure they're protected in case an asset doesn't perform. So if they have 70% of the end value, they have enough room where they can finish it. They can finish it, they can sell it off, and they're protected. So 70% loan to value, very important number here. Another metric that you're going to see a bank use is LTC, or loan to cost. So a bank is going to be a balance between total loan to cost and the loan to value. And a loan to cost figure that you're going to see is 90% of the total cost. So an example here, this is probably going to make things, and again, these right here above are going to determine the total loan amount that a bank or hard money lender is going to give you. So example purposes, let's say we're going to buy a property for $500,000. We have a renovation budget of $200,000. We're going to sell for $1 million, just as an example. So Loan to value, 70% is going to be of what this is going to sell for, the ARV, what you're going to sell it for. We're going to look at 70%. So 70% of 1 million equals 700,000 max loan amount. So the bank will never give you more than 700,000 of the 70%. Some of the hard money people can go a little bit higher. There's a couple guys we work with who go to 75%, but 70% is kind of industry standard. Now, what gets interesting is this 90% total loan to cost. Loan to cost is going to be all your hard costs. So purchase price and renovation. And you're going to be at 90%. So it's going to be 500,000 plus 200,000, which is 700,000. Whoops. Times 90%. Again, 90%, we're looking right here, 90% of the total cost. So that figure here, 700,000 times 0.9 is 630. So what we're going to be looking at, your loan to value, you can get up to 700,000. But in this example, your loan to cost, your 90% is only 630. The bank is going to give you the lesser of these two figures. So we're going to use hard money as an example. Right now, industry standard, you're going to be 15% down for hard money. And down is going to be reflected off the purchase price. So 500,000. If I'm flipping this house, I can assume I'm going to bring 15% of the 500,000 to close this property. So 15% down. This is how we're going to get the loan amount where we're at. We already know our maxes based off your loan to cost and your loan to value. But with this example, what is our loan amount actually going to be? So purchase price, it's 500,000. I'm putting 15% down. So the bank is going to give me 85%, right? Because I'm putting 15% down. The bank is going to give me the rest to acquire this property. Are we following right here?
Yep.
So at 85% of 500,000, the bank's going to give us an acquisition loan of 425,000 because you're putting 75,000 down. Bank gives you the 425. So acquisition loan of 425. We have a construction loan or budget of 200,000. Right here. So acquisition loan plus construction loan equals 625,000. Right? 425 plus the 200. So we look at this 625. We're under the 90% loan to cost, and we're under the 70% loan to value. So this right here is a good loan. We can do this loan because it meets the criteria of what the bank is willing to loan. Questions on this? And this is a pretty standard example.
Yeah, what is typical for working with developers and investors? Are hard money loans typically preferred?
Are they typically what?
Preferred.
Yes or no. So you get two sides of thought on this. Hard money for experienced developers is high interest, which means less profit, so they don't like it. A more savvy person might look at it and say, yes, I'm paying more on interest, but I'm using less cash. If I were to go to let's say a regional bank, let's say I'm going to go to Needham Bank and get a loan, do this exact same loan, I have to put 25% down payment. That is you have to, no less than 25%. Going hard money, you're going to be at 15%. So you look and you might say, I'm paying 3% more on interest as an example, but I'm using 10% less cash. So hard money, it's advantageous because you can get these properties for less money than going to a bank. And also with the bank, they're going to look at W-2s, tax returns, and all that. So you have to have, the bank has to justify giving you a $630,000 loan versus hard money. They're going to look at this deal and say, yep, 625, sell for $1 million. Let's make sure we get an appraisal done on this. Yep, asset looks good. You're good to go. And you can close in 2 weeks, no contingencies. So it's definitely different. So I like hard money because the metric that I care about most on flips is cash on cash return. Cash on cash, meaning how much cash am I actually putting into a deal of true equity, down payment, closing costs. How much money is that making me? If I'm putting 10% down to save 3%, that's a lot more money I have to put into a deal for a little bit more profit. It's not worth it. So it's just about maximizing the leverage. Once you get into like new construction homes, single family homes, or developments where you're doing a few homes at a time, you're going to want to look and try to get them into regional banks because the carry time and the cost it gets pretty substantial. So a couple other terms that banks are going to look at and that you're going to get comfortable with. The as is value. What is the asset worth right now at the time of acquisition? LTARV. This is very similar to the loan to value, but sometimes you're going to see LTARV because this is going to show you the loan to the after repair value. Some lenders look at a loan to value here and they'll look at it as the loan to the as is value right here. So LTARV is going to show you legit, this is the loan based off the end value of the property. So where things get interesting, again, these are going to be the biggest things you're going to see. When you're talking to flippers, developers, builders, other questions you're going to see, and they're going to ask if they're savvy, is what's the leverage? How much leverage do I get with a typical hard money loan, or if you guys connect me with hard money? Leverage is going to be these terms here. You're going to say, we can go up to 70% of the loan to value or 70% to the LTARV, up to 90%. So I should write this down here. Up to 90% LTC or loan to cost. That's what they mean by leverage. This is how much money the bank can give you, the hard money lender will give you to do this deal. Interest, what is the interest rate? Savvier, more experienced borrowers, hard money, right now can get about 10.5%, 10 to 10.5%. Standards are more 12%. Points equals closing costs. So 1 point equals 1% of the loan amount. So for this example that we did here, I'm buying for 500, renovating for 200, going through our figures here. our loan amount is 625. Industry standard hard money. Charge 2 points up front. So 2 points is 2% of 625. 1% equals 6,250. 2 points is 12,500. So as you're having these conversations, hey, what's the leverage that you can do here? 70% loan to value up to 90% loan to cost. Great. What kind of interest are we looking at? It depends on where your experience is in the deal itself, but as low as 10.5%, more likely probably around 12%. Okay, and points, industry standard, 2 points, more savvy people, maybe 1.5, something like that. You'll also hear about prime rate. Prime is going to be the best way to think of prime is kind of like the universal standard for the cost of money. More conventional banks, regional banks are going to base their loans or their interest rate off prime. Prime right now, Taylor, correct me if I'm wrong. I want to say it's 8.5%. It was 8.25. It went up again. So I think prime right now is 8.5. So if you go to a regional bank, you're going to say, hey, what is your rate at right now? They might say something like prime or prime plus 1, which means 8.5% plus 1%. You're probably not going to deal with these as much because if they have relationships with a regional bank, they already are going to go deal with the debt. Hard money is more going to be just standard 11, 12% interest. That's that. So you don't have to really know this. Just be aware that these are conversations that might come up.
So with points, can you dive a little bit more into like the point section? Like whenever they say they need 2 points up front, so are they wanting you to pay them up front, like that 2 points? Like, all right, well, before we move forward, I need you to give me $12,500. Is that how it works?
Not as like a security deposit. It's going to be, look at this as like closing costs. So like if you were to introduce a first-time home buyer to a property, they pay 5% down. They're going to put 5% down on the property, and then they have closing costs. So closing costs, mortgage fees. I mean, even a standard first-time home buyer is going to pay some portion of a point based off the loan amount. So that's just your closing costs of what the bank charges to give you this loan. So for this example, your down payment is 15% of the purchase price, which we decided was what, 75,000. Let's say it's 2 points at closing. So these are closing costs that you're paying the bank to get this loan. We said it was 12,500. So you can assume cash to bring to the closing table is 87,500. Did that answer your question?
Yeah, I did.
Okay. And you'll talk to more hard money guys about different points. The more risky or more simple a loan might be, the more they may charge in points. Like there are hard money guys. I was talking to Wendy yesterday. If you guys haven't met her, meet her. We were talking to her yesterday, and she has a hard money guy. Very easy. He's a cash guy, just a local cash guy who likes to invest in as the bank. He charges 12% interest and 4 points. That's brutal. It's very expensive, but you can get a deal done very, very easy. But with this example, you're going to pay $25,000 worth of points that goes immediately out of your profit. So just be aware with that. Other figures you want to talk about, or terms you want to talk about? Debt. Debt is going to be. Oh, sorry, Hannah, just saw your question. Hannah just asked, what would be considered a risky loan? A risky loan really comes into the point where you're over leveraged, meaning like let's say I'm a cash guy. I don't really care about the figures, the leverages as much, so I'm going to give you more. I'm going to go over leverage. So for this example, let's say the borrower needed let's just say 275,000 for a loan amount. All of these figures were based at 200,000, but he needs 275 to do this. Well, let's see where we're at. Construction budget, let's say this changes to 275. So your acquisition loan plus construction loan is now 700,000. So you're right at 70% loan to value, but your loan to cost, again, 90% is typically a max. Your loan to cost with this is 500,000, right? Purchase price plus construction budget is 775. And you're requesting a total loan amount of 700,000. So you divide your 775 by 700. Your loan to cost in this example is 110%. LTC with 275K. And again, what I did here, acquisition loan plus construction loan equaled 700,000. 700,000. Oh, whoops. Loan to cost. Purchase price 500,000 plus construction budget, which we just changed to 275, equals 775. 775 divided by 700,000, because this is the value right here, gives us 110% loan to cost. So this is drastically higher leverage, over leveraged versus what a typical loan will be. This, in my mind, is a very risky loan. I'm not saying I won't do it or hard money lender won't do it, because it's still at 70% of the loan to value, but I'm putting way too much money up there for what it's worth. I might charge you 4 points. I might charge you 13 or 14% interest because I have to justify the risk with giving this loan. Great question. So going back to a couple last terms, debt is what the bank or the lender gives you. That is not money that you bring. That is money that you are signing on to get. A bank loan, hard money loan, anything like that. Equity is cash into the deal. We're talking down payment, closing costs, legal fees, interest. You have to pay the bank every month, so make sure that you have interest set aside to be sure that you're paying the bank. Equity, down payment, closing costs, legal fees, interest. As you're talking to these other builders, flippers, developers, you have a segue. You can connect them with debt, construction loans, hard money, so on and so forth. But your company, Winder Realty, will actually invest into the deal equity. We will invest your down payment if you need it. We will invest your closing costs if you need it. We'll fund your interest payments if you need it. So we offer a lot for these flippers and developers to have success. Typically, the equity is the biggest constraint on why a builder, flipper, developer can't do more deals? I'd say these are probably your biggest terms that you want to look for. We're a little ahead of schedule, which I like, but as you're going through and like rewatching stuff like this or rewatching this video, really understand those terms, because this is what's going to give you knowledge to talk to the people that you're trying to earn these business from. I wish Kevin was on the phone this morning. Kevin is a newer agent, kind of diving into it, and he is fully diving into talking to builders, developers, flippers, cold calling them. It's awesome. He had a call yesterday, picked up a new client who's looking to do flips in Wakefield, Linfield, and he didn't have a couple of these terms ready, but he called, which is better than anything. But if he were to go through and say, okay, hey, what are you using for debt? They're going to say, I'm using hard money at 12 and 2, 12% interest, 2 points. He can go through and say, okay, what leverage did you get it at? They might say, oh, they stayed at 65% loan to value. This is what the developer will say. Now you can come back and say, oh, what if I can get you cheaper rate, say 11.5% interest, and I can give you higher leverage? I'll go up to 70% loan to value. You're getting them more money, more leverage to have success with their job. So really understand these terms as you talk to builders, flippers, investors. You'll see these terms every single time. So just be aware with them.
And just to kind of piggyback off of what you're saying, and excuse the cartoon that you might hear in the background of my little baby that's singing, so just ignore her.
It's yours.
No, so this stuff is exciting because I'll give you guys an example. All this information is awesome information. About a year and a half ago, I had a chance to sit down with a couple of investors. Vinny, one of them that you know, Tyler, he had and I think you know about this deal. He had a 36 unit approved apartment complex that he wanted to sell, and there was a Chinese investor that was interested. So we sat down with the Chinese investor and with their agent at a table. And I mean, we sat there for 3 hours, and all these terms, which I had no idea about. I mean, they were throwing these terms out, points, LTV, everything that he just mentioned. And of course, I'm sitting there just soaking it all in. But having this knowledge, you can actually sit down at tables with investors, because, you know, we're going to get to a point where we are dealing with investors from different countries. They're going to be coming here wanting to do business, whether it's here in Massachusetts or, you know, as we start to spread throughout the United States, we're going to be meeting with these investors. And knowing this stuff is going to be key, because then that makes us look that much better and smarter, and we can actually, you know, cut a better deal with our investors and with, you know, whoever's at the wheel of the deal. So this is awesome stuff.
Well, and exactly like you said, it's giving you knowledge and firepower to earn their business. So like if you go and you see a dumpster in a house is being built, you stop in, you talk to the builder, you at least have questions you can ask. Oh, wow, how did you finance this deal? Oh, I use hard money. Do you mind asking what you paid for it? I paid 12 and 2. You know what that means. And now you can immediately segue in and say, would you be open for me looking at your next deal and trying to save you money on the debt? They're going to say, yes, absolutely. Try to save me money. You have an in. Or they might go through and say, no, I've known these guys for years. I'm working with them. That's that. Perfect. No problem at all. Let me know if you want me to take a look at it. But at least you're keeping conversation going and knowing what they're talking about, because it's going to segue into this conversation, this conversation, this conversation, all these other little pitfalls that you can use to get their business.
Tyler, I have a question. So when you said that if they're, you know, if you could make them more by saving them here or XYZ, right?
Yep.
How are you doing that? So because you're not like actively negotiating, right? The loan, right?
If they already have their loan, like for that example, dumpsters in the driveway, houses being built, they already have their debt. What you're doing is you're building up the next deal. Hey, on your next
Oh, okay.
deal, can I help you try to save some money?
Got
And
it.
and then you're working with them right off the bat. Even if he says yes, he might get a deal, and then now you're the first phone call. Hey, Brooke, I just locked up this deal in Sharon. It's a flip. I'll send you the numbers, but he's calling you first. It gives you an opportunity to tell him it's a good deal or not. If you
Mhm.
tell him, hey, I'm going to save you some money. Now, can I represent you as an agent? You're going to save him money on the debt. You're in the conversation and you can submit an offer for them. Or you say, hey, if I can save you some money on the backside, thanks for coming to me. Can I list this for you on the backside? You're the first phone call, which is great. So how that works is if they say, yes, I'm open to it, great. Next time you have something, or if you want me to run numbers for you, let me know. And then you can just connect me directly with them and I'll talk about the debt with them. I'll work with them and I'll get their debt aligned. So you don't have to worry about it. You're at that point, you're just going to run numbers and say, hey, here's what we can probably give you: loan to value, loan to cost. Honestly, don't even have to dive into that. You're just going to say,
Mhm.
this is what it's going to be worth at the end. Here's what I think you should pay. And then I'll worry about the debt.
Okay.
Good
Got it.
question.
Thank you.
Yep. But yeah, 12 and 2 is pretty standard. I got term sheet yesterday from it's a non-local lender. It's a nationwide lender. Is at 10.5%, but they require more. So the cheaper money you get, you can expect to have a deeper underwriting process because they're going to give you the best loan. They want to make sure it's for the right people. Good question.
Good stuff.
And Taylor is begging me to upgrade Zoom, and I'm a cheap person, so we have 3 minutes left. If we don't have any other questions, we can hop off. If not, if you have any other questions on the side of this, you have a couple minutes of open forum.
Nothing in particular. This is all good stuff. Brooke, I'll connect with you afterwards. I'll give you a shout on the phone, and then we could talk about setting up some training with you.
Perfect. Thank you.
Yeah, absolutely.
And Taylor, I talked with Kevin and Brooke this morning, and Hannah. Let's set up maybe later this week. I want to get everyone set up on MLS drip campaigns, so they can start getting notified when new stuff comes on, like particular to their markets. I want to set up a training on that.
Yeah, absolutely. Yeah, I'll get that put together. Send invites out to everybody.
Perfect. Awesome. Thank you guys. Questions that come up, let me know. Taylor and Brooke, I know you guys are connecting. Hannah, any questions that come up, let me know. Taylor, why don't you bring us home?
Awesome, guys. I appreciate it.
Cool. Thanks, guys.
All right,
Great.
later,
Thank
guys.
you. Bye.